much nowhere else to hide when you think about NVIDIA, Match, AMD, PayPal, Amazon, you name it, right? April really was a tough month as you're facing higher inflation and, of course, the rising interest rates that follow that. Change of the board, I think what's interesting, you've been doing this a lot on your program, is sort of the defensiveness of this nature. On record, you had staples outperforming discretionary in April, sort of the huge divergence that we continue to see. I would argue that perhaps some of these staples are those, of course, that can pass on some of those higher costs to consumers. And at least for now, consumers, they are doing okay, but I do wonder when you start to see a pivot, definitely more towards staples and away from some of those discretionary items, as typically budgets are fixed and you only have a finite amount of money to use. I think sort of quickly here, one thing we've been talking about, John, when we think about this is real wages. Yes, they are still negative. We've talked a lot about the big wage gains, but if inflation is still growing faster, then the wage gains are not enough to keep up with that.
Taylor, thank you. I just wanted to pick up on something Taylor said and fold in the work from Morgan Stanley and Mike Wilson on the defensives. This is what they said last week, quote, "We suggested the bear market was entering the phase when virtually nothing would work, even defensives." They added to that this morning saying the market is currently so oversold, any good news could lead to a vicious bear market rally, but we want to make it clear this bear market is far from completed. The words of Mike Wilson and Morgan Stanley this morning. I think that quote on the air is wrong, but Morgan Stanley, Mike Wilson, just to be clear on all of that. I want to turn to Alicia Levine of BNY Mellon, recommending industries with pricing power and saying the following, pointing to high-quality defensive growth sectors such as energy, materials and industrials. Alicia joins us right now. Alicia, just to come to you and start with the index story last month, down almost 9% in April on the S&P. Worst month going back to 2020. The Nasdaq 100 down 13%. Worst month back to going back to 2008. And your line here, avoid passive investing in 2022. Alicia, I think we have to start there. My audience has heard that year after year after year after year. Why do you believe it's true now?
So, good morning, Jonathan Ferro. And yes, April was the cruelest month, which is not normally the case in markets, as you know, but it was this year. Look, part of the reason that we say avoid passive investing is that there are going to be very few sectors that can come out of this inflation rise and the tamping down of inflation by the Fed, and they're just not large enough in the S&P to drive the index upward, right? So they can stabilize the index, but it's not sufficient. And if you look at what's happened with multiples just in the first 4 months of the year alone, the forward 12 month went from 21 times to 17 times, which is the 25-year average of the S&P. That was all done in 4 months, and it was mostly done on the back of growth stocks, not on the back of value stocks. And so you had a severe multiple compression in growth, and that's what drove the S&P lower, not so much the compression in the value. So, we'd say here that you should really stick to sectors that can earn through inflation, that have sticky pricing power, and that we can see to the other side.
The breakdown, as you point out, just the weightings, I think, tell that story pretty easily. Energy makes up 4% of the S&P. Apple makes up 7% of the S&P. You can tell which is going to be more important. From a sector basis, let's build on that then, Alicia. What do you want to own? What do you want to avoid?
So we've been talking about owning CapEx here. And so it's not really sector specific, but it really is two things. It's the hard asset CapEx, because we do see a reshoring of supply chains to the U.S., not in its entirety, but enough to drive investment and enough to drive earnings in the companies who are the recipients of that. And also on the tech side, CapEx, because clearly digitization of pretty much every industry is happening and happening rather quickly, most notably in retail, actually. So those companies that are the recipients of CapEx, which we still think happen, will do very well. We just think you have to be very careful here, because what we saw during COVID, that it wasn't just certain household goods that over-earned, but it happened within the tech sector as well, as we saw last week in some of those earnings. And so when companies have over-earned, they're going to be punished by multiple compression until you weed all of that out of it to where you were in February 2020. The pain is not fully done yet in some of those sectors, we think. So you've got to go with the names that really were somewhat pandemic losers here, and that means the reopening trade for now. But
Alicia,
the interesting thing here, Jonathan...
Can I just jump in, just on defensives, forgive me?
Yeah.
Morgan Stanley and Mike Wilson said that even defensives won't work in this market, and we saw evidence of that in the last couple of weeks. Do you push back against that in any way, shape or form?
Look, I push back because the money has to go somewhere, and we tell our clients to be invested, and so therefore we think the defensives will outperform the higher growth and the higher multiple names, and so we are invested there. So utilities and healthcare and staples, we have overweights to that, and we still like energy. Energy may have spiked on the hard asset on WTI, but we think that prices stay higher simply because the supply issues coming out of Europe are not going to be easily fixed. And supply takes a long time to get going here in the U.S. It may happen eventually, but it's not going to be overnight.
Let's spend a bit more time on the banks as well. That's something that didn't work out in a way most people anticipated. Alicia, I've lost count of the amount of guests that came on this program at the start of the year and said, rate hike cycle is coming, get in front of the banks, get long those names, things are going to be good. Hasn't happened. Why hasn't it happened? And do you think it changes anytime soon?
Yeah, look, it hasn't happened because the fears of the cyclical slowdown were coming at the same time as we were expecting rate increases. So the fears of stagflation were right on top of the inflation ramp and the Fed hikes. So that's why it didn't happen on the bank side, because of the fear that the cyclical side was going to weaken the fundamentals there. Have they come down enough? Probably not yet. Probably not yet. I mean, the way we get out of this is that, inflation has to look like not just that it's peaking, but it's starting to come down on its own. So we don't want just peaking at a higher level, but starting to come down on its own without the Fed having to go past neutral. And we need earnings to hold up, earnings and margins. And if that holds up, then you can stabilize the markets. And sentiment is so universally negative, while starting this month, corporates are back in there buying back stock to the tune of billions, $5 billion a day. So we think probably in the short term you have a nice rally here, a nice tactical rally, but the fundamental side is not yet done. We're not done because inflation has to look like it's coming down a bit on its own.
Is that just a nice way of saying a bear market rally, a nice tactical rally, Alicia? Is that what that is?
I'm not gonna be led into that, Jonathan. I'll say this. We're sitting right at the intraday lows of February. A lot of damage has been done.
Yeah.
And that means best case scenario, it takes time to repair. And I don't think we're done discovering that some of these companies that are sort of hallmark companies out there had a bit of a pandemic bubble in parts of their business, not the entire business, like the classic pandemic winners out there, but parts of the businesses were probably pandemic winners, and that has to be wrung out of the system, as we saw last week. It just has to be wrung out. Doesn't mean the whole business it had over-earned, but part of it did, and we're not done with that yet. We're not done.
Well, Alicia, if we're not done with that, I just wonder, is it useful even looking at aggregate earnings through Q1? Is that even useful if we're not even done with the price correction? Because Deutsche Bank pointed this out. They said, despite concerns about cost pressures, margins remain elevated near record highs amidst robust sales growth. Margins for the medium company have in fact risen in Q1. It's hard to reconcile the earnings with the overall price action, but as you point out, this is about a correction of price and wringing out some really overinflated valuations over the last few years. So Alicia, how instructive are the earnings of Q1?
So the earnings are very instructive, and it's one leg of the stool here. You need to have earnings hang in there. You need margins to hang in there, because without that, then we really do have a bear market. And the reason we're not actually calling for much further downside here is simply because we think the fundamentals actually are fairly good. And the real economy, despite the GDP print, which we know was artificially depressed because of the trade issue, also pointing to the overbuying on the goods sector, despite that, the economy still is coming in fairly well. You need the fundamentals. You cannot ignore it, because that's part of what gives you where the multiple is, right? The multiple is whether or not have we reached a place where margins have compressed enough and we can move forward, or are we going lower? We're at 17 times now for the S&P. GDP. We're at 21 times on the growth side. Does that go lower? That's really the question. Not so much on the earnings side. It's the multiple side here.
Alicia, brilliant, as always. Come back soon. Don't leave it so long. We've got to do this again. Alicia Levine there, FBNY Mellon. Thank you. Coming up, Speaker Pelosi making an unannounced visit to Ukraine.
We believe that we are visiting you to say thank you for your fight for freedom, that we are on a frontier of freedom, and that your fight is a fight for everyone.
That conversation up next.
Is Bloomberg.
We believe that we are visiting you to say thank you for your fight for freedom, that we are on a frontier of freedom, and that your fight is a fight for everyone. And so our commitment is to be there for you until the fight is done.
Speaker Pelosi sending a message of unity as the divide in Europe over Russian gas intensifies. The EU meeting in Brussels to settle their differences, with Hungary willing to veto an oil embargo and Germany looking for a compromise. Joining us now, Maria Tadeo in Brussels and Marie down in DC. Maria, first to you. How close are we, or far away are we from a deal over this kind of thing?
Well, Jonathan, you see how everything is changing here because, of course, the biggest issue was Germany, but now the Germans say they are open to potentially dropping this veto. I spoke with the German economy minister, Robert Habeck, just a few minutes ago, and he said if we do it gradually, and when we talk about an embargo, we should be careful and say this is a light embargo, Jonathan, because it would not be overnight and it would be gradual from now until the end of the year. But he says Germany would not oppose this. The issue is now turning to Hungary and, of course, and Viktor Orban, who says, well, they don't see how this would put an end to the war. They say it would have a big detrimental impact on their economy. And remember, every decision here gets taken by unanimity. You have to agree the EU 27 as a bloc. But I would say one thing, Jonathan, when you look at the Hungarians, throughout this process, they have voted in favor of all of these sanctions. So there is a difference between what Viktor Orban says in public and what he does behind the scenes. And until now, this unity is holding. Whether it happens this week, tomorrow, by the end of the month, that is unclear. There is no specific deadline on it. This, we understand, may not even happen today. But you can see that the sense of direction now, it is clear to see this oil embargo taking place. We talk about oil, not gas for the time being. I put that question to the German economy minister, and he was very careful to say this would just imply oil, not gas. The reason was pretty obvious. Germany still imports 35% of gas. Unplugging from that is very difficult.
And the latter is far more important than the former, as we know. AMH, something's developing stateside that perhaps isn't getting talked about enough. Just slowly, output in America is creeping higher, just short of 12 million barrels a day. Ed Morse City earlier on today said we can get back to 13. Do you anticipate we will start to see results here? Because as someone reminded me, crude might have come back down, gas prices haven't really, and the price of flying jet fuel hasn't in a big way either. Can we make some changes here stateside anytime soon?
And diesel as well, and that's why you see this such a big part of the inflation story, because diesel is what trucks run on, and of course that is really the heart and soul of how you get groceries and goods around America. What you are seeing, Jonathan, what the administration wanted to do is they made this ask to oil producers to pump more, and what they would talk about, I know Amos Hochstein talked about this with you, Tom and Lisa, about a 6-month gap, and that is why they wanted to tap the SPR to hopefully hold them over to when later in the year, they do believe that there's going to be more investment and more production coming out of the United States. We also should note there is an OPEC meeting this week, Jonathan. So potentially we could see action from the OPEC Plus cartel. Potentially that will drive some direction in what we see from other major producers.
Anne-Marie, down in D.C. alongside Maria today in Brussels, as Trevor Noah, the comedian, said over the weekend at the White House Correspondents' Dinner to the President. So you've come into office and since then things are really looking up. Gas is up, rent is up, food is up. Everything is up. To the two of you, thank you. Ed Morse City weighing in on some of this, saying it's unlikely the EU will reach an agreement. Take a listen.
If Germany is not going to use its veto power in the EU, Hungary certainly will. So we don't think there's going to be an overall European community agreement on not pulling in natural gas or oil from Russia. We don't think the Russians are going to pull back because income is better than no income.
Julian Lee joins us now from Bloomberg. Julian, if it's not Germany, it's Hungary. If it's not Hungary, it's Germany again. Any chance of a European-level deal on this kind of thing anytime soon?
I think it's looking very uncertain at the moment. I mean, we have seen the Hungarians repeatedly saying that they won't go along with sanctions, and yet every time they have done. I think energy, and at the moment we're looking only at oil and not gas, as you said, that may be a sticking point. But in some senses, you don't really need an EU-wide embargo. If Germany decides that it's going to stop buying and winds down its imports, if some of the other big importers of Russian oil do the same, it doesn't really matter whether that's done through the EU or not. What matters is who's buying.
Julian, you go a little bit deeper as well, beyond just Russian crude. We took a little snippet of your recent column, and this was the quote we pulled out. Putting restrictions on Russian crude is one thing. Trying to stop the sale of Russian refined products is much more complicated, in part because it's not clear what can or should be included. Julian, can you just speak a little bit more on that? Because I'm not sure how familiar many of us are with that particular story.
Yeah, I mean, it's very easy to see what is Russian crude and what isn't. There are, there's one perhaps slightly ambiguous grade that's 90% from Kazakhstan and 10% from Russia, but I think that that's very likely to be left out of any sanctions, and quite rightly too. But when you get to refined products, it gets a lot more difficult, particularly if you start to think about this big movement that we're seeing of Russian crude going to refineries in Asia, particularly in India, because those refineries then re-export a significant proportion of the products they make. So is a cargo of diesel that is made in India or processed in an Indian refinery that is running Russian crude, does that diesel then fall under sanctions, or doesn't it? Is it Russian diesel or is it Indian diesel? And that, I think, becomes a much more complicated question. My suspicion is that those kinds of products will probably be left out, because if you include those, then maybe you start creating real problems in terms of diesel shortages.
Julian, wonderful to get your thoughts and some clarity on a really important topic, as we've gotten used to in Europe for a long, long time. They talk for a long time and then end up with a fudge and a suboptimal outcome. And to Julian's point, maybe that's what this ends up like as well. Julian Lee there of Bloomberg Intelligence and Bloomberg Opinion. Coming up, the market moving events you need to be watching. That'll be next in our trading diary. From New York City this morning, good morning. This is Bloomberg. Twenty-five, 26 minutes into the session this Monday morning. Good morning. Kicking off the month of May with equities just about positive by 1/10% on the S&P and the Nasdaq, up by 0.5%. That's the price action. Here's your trading diary. At the top of the hour, the ISM manufacturing number, US factory orders and an RBA rate decision on Tuesday, a rate decision from the Fed and a Powell news conference on Wednesday, the Bank of England with its own rate decision this coming Thursday, and finally, we round out the week with a payrolls report in America. The estimates so far, moving target, of course, in our survey, the median estimate 391,000 from a previous number of 431. Big week ahead. Thank you for choosing Bloomberg TV. For our audience worldwide, this was the countdown to the open. This is Bloomberg.
from the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
So we are 30 minutes into the US trading day. It's May the 2nd. What do you need to know? Let's talk about the top stories that we're following for you at this hour. Stocks, to be honest, are struggling to stabilize after Friday's nasty tech-driven sell-off. The Nasdaq's up a little bit, but it doesn't feel convincing yet. Buffett, though, is buying big. Over the last quarter, Berkshire Hathaway has been on its largest spending spree in a decade. It's boosting holdings in Chevron and Activision Blizzard. And European investors are whipsawed by a 5-minute flash crash that started in Stockholm before hitting other Nordic markets. To be honest, the weak China PMI data hasn't helped either. From London, I'm Guy Johnson. Today with Gina Martin Adams in New York. Alex Steele is off. Welcome to Bloomberg Markets. Gina, Friday was ugly. Would you expect this Monday morning to see a convincing bounce back for stocks?
You know, normally after such a massive price correction, you would get a little more optimistic about the day after. The problem is that there's no evidence of capitulation in that price correction. So when we look at things like momentum and breadth, they're still holding in at much higher levels than you would normally expect, considering the degree of price correction. So until we get some momentum and breadth capitulation, I think that the wiser sort of strategy is to fade all bounces.
It's interesting, isn't it? So we initially faded the move first thing this morning. Futures have been kind of in and out of positive territory throughout the day. The Nasdaq's up by around 0.5%, but it's already off its session highs. Let's talk about the data, because maybe that's a factor behind what we're seeing here. We're getting the ISM manufacturing numbers coming through at 55.4. Now that is well at a headline level below the survey that we were anticipating at 57.6. So we've come down from 57.1 to 55.4. The survey was to 57.6. Let's dig into the details because they always matter. The prices paid component, interestingly enough, has faded quite significantly, 84.6. Tim Fiore is going to be joining us a little bit later on from the ISM to give us some analysis here, but that's down pretty sharply. New orders fade as well, down to 53.5, and the ISM employment number comes through at 50.9. That's got a big dip as well. So actually, in aggregate, that number, those numbers are not particularly good, and maybe account for the fact that we are seeing stocks beginning to turn around a little bit off the intra-session highs that we've seen thus far. So let's get back to our question of the day. April was ugly. Do you sell in May? If you haven't already, let's kick it around. Ira Jersey, Chief US Rate Strategist, joining us as well for a little bit of bond market perspective on what we're seeing here. Ira, Gina was joking a little bit earlier on our morning meeting. She was like, yeah, the stocks are being buffeted here. It's pretty ugly out there. We're dealing with some volatility, but we know how to deal with it. For the bond market, that's where the real pain is being felt. Can you answer that question from a bond market perspective? What do you think? Do you sell in May and go away?
Yeah, I think that not having a lot of risk right now in the bond market is probably your best bet. I think that there's likely to be, a little bit more weakness here in the bond market. The bond market's off 8.5% this year for Treasury securities, and that's by far the worst performance. If we were just to end right here, that would be the worst performance ever for the Treasury market. And so I do think that there's going to be a little bit more pain, a little bit more risk. The Fed's going to be doing its runoff of its portfolio, and you're going to have obviously more interest rate increases. So it's hard to like treasuries here right now. I think that will change later this year, but for the moment, I think you have to be very cautious, the bond market.
Ira, talk to us a little bit about where you see the pain in the bond market ending. Where are we going to see rates stabilize? I know in our macro call this morning, you talked about maybe some hope emerging out of the third quarter in terms of rate stabilization. Talk to us about the short and the long end of the curve and where we can finally see an end to this yield rise.
Sure. So Gina, to your point, I do think that we're going to see additional flattening of the yield curve. I mean, part of that is just the Federal Reserve hiking 3 or 4 times, 50 basis points each time. That's not unprecedented yet, but you have to go way back to the late 70s and early 80s to see that type of action by the Federal Reserve. So I do think that the front end of the yield curve can move probably another 50 basis points higher. So for 2-year notes, and for 10-year notes, you're talking about maybe another 20, 25 basis points. So basically, typically we're talking about everything completely flat, just above 3%. And that's usually a pretty good time to think about buying duration. So thinking about buying market risk is when the yield curve gets to completely flat. And over time, what usually then happens, and I think that this will probably repeat sometime over the next 12 to 18 months, is that the long end of the yield curve winds up rallying and you get an inverted yield curve. And the reason for that is just expectations of a slowing economy and slower inflation at some point in the future. Importantly, I just want to turn this back on Gina maybe for a second. We now have 10-year real yields, so 10-year TIPS yields are now positive for the first time in quite a while, and you have 5-year real yields looking like they're going to become positive over the next couple of months as well. Does the stock market look at that at all, Gina, or is that something that you think is just going to come and go and nominal yields matter more?
Yeah, I think it's a really good question, Ira, because I do believe the stock market looks at it. In particular, the stock market likes the short end of the curve. So we tend to rely on the 2-year and the real yield in the 2-year as a pretty predictive indicator for the equity market. I think in terms of the broad market outlook for the equity market, you've got kind of this double-barreled negativity right now. You've got earnings, which unfortunately we're seeing earnings expectations come in, largely reflecting what's happening in China and the slowdown in China. And now you've got some ISM numbers that are looking a little bit weaker than anticipated here in the U.S. A slowdown in the housing market certainly coming over the next several quarters. So you've got a sort of a downdraft in earnings expectations on one side, and then the discount rate that you would apply to those earnings growth expectations is also going higher. So you've got this sort of double-barreled pain in the equity market and nowhere to turn until rates stabilize and or the earnings outlook stabilizes. It's just really difficult for stocks to find their footing.
Equities waiting for the bond markets. Guys, we're going to wrap it up there. Thanks very much indeed. Ira, always a pleasure. Thanks for jumping in. Gina and I are going to stick with you, but I want to turn our attention now to what is happening at the Milken Institute Global Conference. Bloomberg Business Week editor at large Eric Schatzker currently sitting down with the Apollo CEO, Mark Rowan. Let's take a listen into that conversation.
Better off you did. Okay, it's now about to run in reverse. So S&P 4,100-ish. Last I looked, end of 19, it was 3,000. S&P PE today, 21. Long-term average, 16. It's just not that bad. People, power of the business.
Okay, you've brought up the market context. It's probably worth us spending a few minutes, at the very least, talking about that. People would probably say it feels like a challenging time to invest for some of the reasons that you just enumerated, right? There's a lot of inflation, the most we've seen in 4 decades. There's war. There's the prospect of rising rates. There's quantitative tightening. We haven't seen that really in a serious way yet. You mentioned that there's a correction in the equity market. There's a correction in the credit market too. What kind of future are you preparing for?
A volatile one. I mean, but I start with, sometimes I'm asked to explain what our strategy is, and I put it in 3 words: purchase price matters. So if I can buy a fundamentally good business today at 15% less than I could buy it 3 months ago, that feels like a good outcome. Will there be bumps along the way? Will there be deviations? Of course there will be. But I think the notion of purchase price matters. Some call it value. In the extreme, you can be like Warren Buffett and Charlie Munger. But I think it's a strategy that's built for multiple market cycles. In the equity business, it's the price you pay, it's the companies you buy. And in the credit business, it's being senior secured, it's not being long duration, being floating rate. There are lots of ways still to protect yourself. Maybe it doesn't feel as good, given what we've been through and just how positive the last decade's been.
No, it certainly doesn't feel as good. But on the subject of purchase price mattering and value as a concept and time as something of an unknown, is 15% enough? If you can buy something for 15% less right now, might you be able to buy it for 30% less 6 months from now?
Perhaps. I mean, this is always the question of what's cheap enough and what's worth doing. I think we have more to go.
More in what sense?
I think there's more of a correction to come. I think, being a macroeconomics prognosticator is not what we do, but understanding fundamentally good businesses that maybe had more options 3 months ago and have fewer options today, we'll find that category of things that make sense for us to do. We always do.
Yes, history would suggest so. But if you don't have the luxury of being the kind of investor that Apollo is, and you put yourself in somebody else's shoes for a moment, do you look at the market and say to yourself, I think the future that I envision is relatively priced in, even if there's a little bit more of a correction to come, or that is not a knowable answer right now?
I don't think it's a knowable answer right now, but certainly we saw in today's announcement from the Fed the signs that they are taking the need to get inflation expectations under control very seriously, and that will manifest itself through their liquefying their balance sheet and selling down, which they outlined this morning, but also through rate increases. But, I was in D.C. last week, and I spent there's a lot of free time, by the way, in D.C. It's a great time to go and visit. And the key point I was making is that everything that you believe prior to 2008 no longer exists. And in the context of your question, I'll take public markets. 60+% of the equity market today is indexed.
Is which?
Indexed, meaning it trades on liquidity. Just people going in and out. The fixed income market, 100% liquidity driven at this point in time. And so investors...
The public fixed income.
Public fixed income markets. Investors who are relying on public stocks and public bonds are finding out that everything is correlated to liquidity, because you've had one of the worst first quarters ever. You've had equities down about 14%. You've had investment grade credit down 17%. Wasn't that supposed to be riskless? And I think institutions kind of already know this. Public markets have become beta, and if you want excess return, you need to step back from the public markets.
So what you've just said, I would summarize with something along the lines of, we've lived through a dozen years of rock bottom rates and most recently endless liquidity, and it felt like a riskless era. Does risk matter again now, for the first time maybe since before the crisis?
Absolutely. I think we're seeing things correct. We're a long way from means or medians. In the equity market, we're 30% from the median, which is pretty scary. And the credit market, we also have a long way to go. But I do think that the mentality with which investors have focused, they've been lulled into this sense that everything goes up, that everything is supposed to go well, because we've had, one could say, 30 plus years of declining rates, but extreme liquidity in the past 14.
So if you think about what you see and what you anticipate, you have an idea of what businesses of yours still work. What businesses don't work anymore? Yours or others?
Look, I think the on-the-run, long-only markets business are very difficult. To the extent you have been the beneficiary of trends. So, there'll be a number of speakers who will come here and will talk about the massive increase in technology and the technology growth curve. And I would say tech and growth in particular have benefited from low rates because their business plans are further out, they're discounted back at much lower rates, therefore they've been the beneficiaries of this speculative boom. And to quote one of the speakers we'll hear from later, technological change is real, it's fundamental. But that doesn't mean the purchase price doesn't matter, and the entry point doesn't matter. So I think people who have benefited from this extreme low rate, high liquidity environment where all manner of growth have been rewarded, I think that's where the greatest correction will come.
And that, of course, is not just the ETF manager whom you're thinking of. That presumably extends to growth equity, it extends to late stage venture, early stage venture?
It extends,
the whole spectrum?
It extends to all these markets. I look at the traditional alternative market, and so much of the traditional alternative market has become beta as well. Even within our own firm, you know, my joke internally is, you've worked for me for 10 years, but I still don't know if you're a good investor. I think we're about to find out.
Any sense, having lived through, what now, 3 solid market cycles?
I'd say 4.
4?
Yeah.
How long does shakeout last?
No.
No. A known unknown.
Look, if we profess to know, we just mislead. But what we can do is return to some basic playbook. So I look at the 3 businesses we're in. We're in the equity business, we're in the hybrid business, and we're in the credit business, or the yield business. Of those 3, the yield business is our largest, some $360 billion. Senior secured, top of the capital structure, floating rate, generally shorter duration. That feels like a good place to be, and it feels like business is going to be good because credit creation is going to be more difficult. That generally is good for people who are able to create credit. If I move to the hybrid business, hybrid is the piece of investing where you give away all the upside in return for downside protection. You essentially become a solutions provider. That also feels like a pretty good business. People are going to need solutions. To the extent your business plan was predicated on raising easy money every year, maybe it's changed. Toughest business will be the equity business, because the equity business is the most volatile in difficult economic times. But there, it's very granular, it's very company specific, and there are a whole host of sectors that will not see cycles as a result of what's happening at a macro level, where they're just fundamentally good businesses.
Credit hasn't seen a real distress cycle since the great financial crisis. Will it see another?
At some point it has to. You know, look, 2008 is actually a really good dividing line for the credit markets. So much changed. The role of the banks changed, the role of the investment marketplace changed. But you're right, it has not been tested. We have, as a general rule, not seen the kind of speculative excesses that we saw prior to 2008. This, at least the corporate side of this credit cycle, feels more benign. You don't see the same kind of pent-up leverage, or systemic leverage, or use of off-balance sheet leverage. So I would expect it to be significantly more benign than we did, but inevitably there'll be corrections.
Is that also because the lenders have less, thanks to the deterioration of documents, have less power over the borrowers?
I'm not sure I would say it. Look, I said when I was in D.C. last week, Dodd-Frank worked. Dodd-Frank took risk out of government-guaranteed institutions and put it into the investment marketplace. So in the U.S. today, the banking system is less than 25% of credit creation. In Europe, it's 65%. In Asia, depending on the country, close to 90%. We have essentially matched credit and the creation of credit with institutions who have the capacity to hold long term. That's not true in every market. We still have open-ended mutual funds, we have ETFs, we have some mismatches like that, but we don't have the kind of built-up leverage on regulated balance sheets that we had pre-crisis. So I personally would expect a more benign crisis.
Mark, you referred to this earlier, the 30-year, call it, bond bull market. That was an enormous tailwind for the industry that you and your peers in private equity and more broadly alternatives have built. And then, again, as we've acknowledged, the tail end of that was the most aggressive central bank easing since the Great Depression. Now that we're living in a different era, for however long it lasts, it's definitely a different era. Does a different era require a different strategy?
I don't know. I mean, I'll give you for us, and every market participant will be different. We built our yield business on the back of what I call fixed income replacement. Think of actually replacement of investment grade fixed income, but with more yield. And we built it to serve initially our own retirement services balance sheet, Athene. The way that business works is we make promises to retirees, and we back those promises with highly rated credit. Whether rates are high or low is not really that relevant to us. It's about spread. Because if rates are high, promises we make to retirees will be high, and if rates are low, promises will be low. Our job is to earn a spread. And therefore, inflation, market price of securities does not really impact the way we invest or how we think. Very much like a pension fund or an endowment or a sovereign wealth fund, where they also have obligations, sometimes fixed to retirees and sometimes not fixed in the case of a sovereign wealth fund. And so what we're seeing is the biggest rotation is the acceptance by institutions and others that publicly traded markets offer beta. And if they want excess return, they need to go step back from the daily liquid market and do something else. So is that different? Maybe so.
A couple of questions arise for me out of that. What about a recession, defaults, and credit losses? And then I'll get to the second question after that.
Look, the fundamental risk is collectability. And it's why in an uncertain time, and the business we've elected to scale has been fixed income replacement. Not high yield, not levered loans, all of which have a place in the financial ecosystem. But the business that we are massive in is the top of the capital structure, senior secured. Typically in a recession, you do not suffer significant losses if you're a good investor. We've been through a mini test for COVID and the shutdown we had in 20. We like where we stand, but I would much rather be at the top end of the capital structure today than at the bottom.
And then on the point about the nature of the instrument and the degree to which it offers alpha that you can no longer find in public markets, how long is that sustainable? Think about the amount of money that you're deploying into private credit every day. I could look at what's going on at your peers, right? The amount of money that they're raising in permanent capital vehicles and that they have to invest. This just keeps mushrooming. And at what point does that begin to erode the alpha that remains in private markets?
I think we're a long way from that. And there are very subtle gradations today that are taking place in the marketplace for alternative credit. So there are two words that go together but actually don't mean anything: private credit. They sound like something, but they're not. Because private credit can be the most risky private credit. It can be financing of levered loans, or it can be the most secure. Each of the alternatives firm have chosen their place in the ecosystem that they want. The bet that we have made is at the top end of that. The primary competitor for us is not Blackstone, KKR, TPG, Carlyle, Ares, Brookfield, whoever. It's JP Morgan, Goldman Sachs, B of A, securitization market. And I feel at $360 billion that we are just like that. We're just not a massive player yet in the market. We're growing fast. As I've said, this business is going to double over the next 5 years. Even at $750 billion, it's just not that big in the scheme. The market is immense. I mean, I look at one little sector of it, energy transition. Little Apollo has put out $20 billion of energy transition financing over the past 3 years. We'll do another $50 billion over the next 3. The need for capital, and by the way, most of that financing, senior secured, project type financing, or a little bit of hybrid, it is not for the most part risk. It is not for the most part equity. The capital needs of our country and the world, given the state of change, not just in technology, but in commodity usage, are immense. So I think the market will definitely get more crowded. There is no market that persists for very long without increased competition, but at least at the little sector we've chosen, we have a long way to go.
I was going to save this for the end, but I'm going to front load it because what you just said reminded me of it. What you're talking about, Mark, is such a different business than the business that you got into 30 plus years ago.
It's like night and day. You know, so it's actually funny because I find myself now going, for instance, in DC last week, explaining what it is we do. So I go down and I say, first, what is an alternative? And people look at me, well, of course, it's like private equity and this. And I said, no, an alternative is nothing other than an alternative to publicly traded stocks and bonds. Some alternatives can be rated AA, and some alternatives are equity. There is nothing inherently riskier about private or alternative than public, just like public can be AA to really risky. And so what we're seeing is the growth of this marketplace. Given the indexation of public markets, we're seeing the private market massively expand in size and scale. And the alternatives firms, in their own way, are picking their spot along that continuum of AA down to equity as to where they choose to grow. And I think we look forward 5 years, our clients' portfolios are going to look profoundly different.
In what way?
Well, you start with the top end of the scale, the most sophisticated institutions, the largest institutions in the world. They were backers of the alternatives industry. They were well known. Now, of course, they want to be our partners in the alternatives business, and increasingly they are becoming our partners in the alternatives business. As I said, there's no permanent friends or permanent enemies anymore. Everyone is in a state of flux. The other place we're seeing just massive change is at retail, particularly high net worth. You know, over the past 3 or 4 years, we have seen nothing short of a revolution in alternatives take place in the retail marketplace. And that's without yet starting. All retail is seeing thus far from our industry are existing products at institutional fees. Over the next 6 months, I think you're going to see the first products created especially for this marketplace. And it will not surprise me in 5 years if a retail investor's portfolio is 50% alternatives.
50?
Except it won't, alternative will mean alternative to publicly traded stock and bond, not alternative the way many people have associated it traditionally with private equity or hedge fund or risk.
And what will some of these first purpose-built products look like?
I think they're going to solve fundamental needs. I mean, if you think about how a retail investor might have been educated historically, a 60-40 portfolio, debt and equity. Well,
feels like a bad idea right now, by the way.
It's certainly been a bad first quarter. Imagine if you could replace your publicly traded equity with private equity. And I don't mean private equity in a fund, but you could have lower risk, better returns, and some amount of liquidity. How we do that is up to us to crack. But we've spent as an industry 35 years solving problems for the largest institutions in the world. And that creativity has now flipped in part to solve problems for this retail marketplace.
For the first 15 or 20 years maybe of your career, there was an enormous illiquidity premium to be harvested in the private market. To what degree has that premium eroded?
Well, I'd say it this way. So clearly the premium has eroded. So as I sometimes say, private equity started 35 plus years ago as a black art. And people rarely participated in it. And now it's an asset class. And how we as an industry go about that asset class remains to be seen. The firms, and I'll get to this, the firms no longer look exactly the same. Private equity does not mean the same thing to each firm. So for us, purchase price matters. For some of our peers, different story, different focus. I look at the transactions we've elected to do as private equity, Yahoo being among the most interesting, Las Vegas Sands. They are very, as people in this room might say, they're very Apollo-esque. A lot of complexity on the front end, a lot of trading of perspiration for purchase price. It is our mentality, it's our brand, it's how we come to market, and it's timely. Maybe hasn't been so timely for the past few years, We did just fine, but certainly not the kind of market that we really excel in.
When you say you did just fine, of course. But in a competitive context, others did better, right? Over the past 5 years, you have been either outperformed by your peers or underperforming your peers. This year as well, I should add. Does that matter to you?
In the short term, no, it really does not. I mean, I look at this business over now 30 years, 32 years in our case. Generally, not generally, mid-30s gross returns, high 20s net return, generally 1,000 basis points better than our peers. I'm very proud of that record. I think you'll see divergence in the first quarter when we all announce, which is next week. So if I'm not right about that, I don't know much about our business. And I think you'll continue to see divergence. But we look at the private equity business as an absolute rate of return business. We want to produce 20% plus net rate of returns for our clients. What clients have not been doing is adjusting for risk. Lower purchase price, less leverage. I'm very comfortable with the place we've chosen in the ecosystem.
I asked you earlier if Apollo needed to change its business model to reflect the new reality. And maybe it doesn't, but do you need to change?
Okay, you're listening to Eric Schatzker in conversation with Mark Rowan, the Apollo CEO. We're going to have more from the Milken Conference coming up a little bit later on. A really fascinating conversation, I expect, with Citigroup CEO Jane Fraser. She's sitting down with Bloomberg's Scarlett Fu. So that conversation is happening in the next hour. Gina, a couple of things really stand out to me from that conversation that Eric was having with Mark. Mark talking about the fact that he thinks that the credit's going to come through this relatively unscathed, or he talks about a more benign environment, certainly relative to 2008. It's hard to imagine a more difficult environment than 2008, but we'll just park that one for the moment. And he talks about the fact that tech growth stocks benefit from low rates and the correction really sort of ongoing in growth stocks, including tech. Does that fit with your view of the world?
Yeah, I think it fits, frankly, with the view of most investors right now, with the exception of maybe credit. I think there's more nervousness emerging for credit, in particular high-grade credit, certainly performing very poorly so far this year is on a lot of investors' radar. Certainly, investors are capitulating left and right on tech. There does appear to still be more to come on that trade. The other thing I think that he said, Guy, that is really reflective of the overall investment universe right now is just this idea that you cannot derive alpha from public markets. I think that there has been just this sea change in mentality over the course of 20 years even, where public markets are just the low man on the totem pole. No one wants to invest in them. Everyone's putting more capital to work in privates. And that's where I would really question the outlook is there really that much more alpha to be derived in private markets? Is it worth allocating an enormous share of your overall portfolio there? Is it really just about not having to mark to market and sort of riding the wave over a longer period and not having to suffer the pain of public markets? Or is there really that much more alpha there? It's a big question for us.
Well, I think also the indexation argument that he was making around that as well, and you listen to what he has to say, and you kind of almost feel as if private markets are basically going to go through the same thing that public markets in some ways have. And it's going to be interesting to see how that ecosystem changes as a result of what he's describing. This much more tailored focus maybe on the retail clients. Absolutely fascinating to see, because ultimately that's the process that we've been through in private markets.
Right.
We're going to come back. We're going to talk much more about this. We've got a great guest lined up to talk about what is happening in these equity markets. Let's figure out exactly what is happening right now, because we've got to digest that ISM data that came through a little softer at the top of the hour. Kriti Gupta tracking all the action.
Yeah, Guy, you'd think it would have a little bit more effect when it came to the stock market, but you are seeing green on the screen. A lot of this might simply be a reaction to what you saw on Friday, that massive sell-off that really capped April as the worst month in 2 years. Well, you're seeing a pretty important technical rebound. Remember, a lot of that is concentrated in tech, where you're seeing NASDAQ outperform the S&P 500
500. That's something that is not necessarily translating to European stocks broadly, though, but just given that the UK is off, I wonder how much of that is a volume story as opposed to anything based on fundamentals. We should also mention the dollar a little bit stronger, that weakness in the yen, the weakness in the euro we were talking about so much last week, really continuing. But let's circle back to the equity market, because as Gina said, it really is about the valuations, it's about the selling, it's about the pain that you're continuing to see in the markets. And let's just take a quick step back. Year to date, you have seen two 10% corrections, one over here, a little bit of a rally, which Mike Wilson correctly pointed out was a bear market rally, and then another 10% decline. So it really speaks to the pain you're seeing in the equity market at the same time as you're seeing a lot of volatility in the bond market. And if you look at the yields, for example, in some of these bond spaces, the 10-year yield and the 30-year yield both trading at parity right now. And this is really interesting as we talk about the FOMC meeting in just a couple of days. How much of that volatility has some of these yields a little bit out of whack, Guy?
Absolutely. A lot of questions. Maybe we'll have some answers by the end of the week. We will wait and see. Kriti, thank you very much indeed. Equity markets are higher, as we were just hearing. So the Nasdaq is now up by 1.24%. Still doesn't feel kind of that convincing. I think we need to see a decent close here, really, to kind of think about what happened Friday and get the context of the Monday correct. But our question of the day basically talks about the idea that we're coming out of April, and boy, was April horrible. So what do you now do in May? The old adage is that you sell in May. We've added, if you haven't already. Let's ask Sylvia Jablonski, Defiance ETF's CIO and CEO. Sylvia, it's always great to catch up. Look, April was ugly. What do you think May's going to look like? What do you think people should be doing right now? We've seen some big sell-offs over the last few days. What do we take away from them?
Hi, great to see you. And yes, you know, the old saying that April showers bring May flowers is what we're hoping for. But, you know, historically, it actually hasn't been the case. It is May go away, and April tends to be a strong month for equities. But look, I think we're in a different situation than we have been before. If you look back from the 1940s or so, you've had about 23 moves where the market has been down between 10 and 20%. And the average decline is about 15%, and that average decline has lasted for about 4 months historically. Now, you know, this time's a little bit different. We have geopolitics, we have Fed hikes, we have inflation. You know, there are a lot of sort of headwinds in the market. So what I think is going to happen in the near term is that we're going to continue to have these, you know, big bear types of bounces and rebounds in the short term. I think we'll have short-term pullbacks that are aggressive and you know, difficult to stomach, like we saw on Friday post some of those big tech earnings. But short-term volatility and you know, PEs that are down from, you know, the 30s to the low 20s, and companies that generate strong free cash flow are part of, you know, secular technology growth stories for the future and things like that. These are good buying opportunities for investors. I still believe, you know, I've been saying for a long time, we're at a tradable bottom. You know, people who sort of bought in on Friday and today did a little bit better than perhaps I have over coming weeks. But I really believe that, you know, the long-term story here of buying at these levels over the past couple of months is going to play out for investors who are willing to hold and kind of ride this out.
Sylvia, can you talk to us about how the bond market plays into your outlook for stocks? I mean, you specifically mentioned those long-term cash flow, sort of secular growers. Those happen to be the companies that are also long duration, most sensitive to interest rates. So are we somewhat dependent upon a top being formed in yields in order for investors to really come back to the equity market en masse? Or do you think we've largely priced in the rise in interest rates at this point?
It's a great question, and I think, you know, it's sort of, it depends on the company itself, right? So when I'm thinking about some of the growth companies, I think that they've actually started to look like value companies. You know, I think Apple, Microsoft, Google, Amazon, for example, I don't think they're going to be greatly impacted by fixed income and rates of borrow. I think they have plenty of free cash flow, and I think that, you know, sort of what happens in the short term in bond markets, and perhaps even in the long term in the next year or two, with rate hikes isn't going to be a huge driver for those names. But for some of the smaller cap growthier names, you know, I do think they're going to suffer in the near term, right? So in terms of where, you know, Fed hikes settle out, how many rate hikes we get, and you know, sort of when they stop and we see some stability in bonds, I think will impact the high growth names.
Sylvia, generally stocks don't like a recession. We've just seen quite a sharp slowdown in the headline manufacturing ISM number. When do you think the recession happens? What does it hit the hardest? When should we start preparing for a recession?
So I don't know when the recession happens. I am not looking for a recession in the next year or so. And the reason why is that I do think that there are still some positive things to talk about in the backdrop. So, we still have this story of the strong consumer. Yes, we've seen some spending slowing down. Yes, we've seen that Amazon number really, kind of brought some fear into the market. But if you look at their 2-year average, actually, the spending growth is looking pretty good and stable at that 7%. Consumers have been out there spending, so that continues. Jobs are at job employment levels are at all-time highs. Wages are higher. Savings still sits at $2 trillion. Consumer debt servicing ratios look great. So, there are a lot of positive factors in the market. And I think what we need to see happen is inflation cooling off. Hopefully we're pretty close to that and we start seeing inflation numbers going in a different direction. Russia, Ukraine is an issue, obviously, and Fed hikes are an issue. But I think what will happen in the next couple of months with inflation will be interesting in terms of what the Fed actually does. I think the market maybe has overpriced Fed hike in, and I expect volatility, I expect the contraction, I expect this sort of pain in the short term, but it doesn't mean that we can't sort of come out of this and see a positive year at the end of all of this.
Sylvia, what's your take on flows in the ETF universe right now? Certainly flows have become something of an indicator of sentiment given the sort of dominance of ETFs over the course of the last several years. Are you seeing client capitulation?
So I think what happens in, the last couple of months is some of the most popular ETFs out there, some of ours included, I think they tend to, take it on the chin first because investors will, when they're looking to raise cash, perhaps they will get out of some of the thematic types of products that they've purchased over the last year or two because, that's not something that was familiar to them in the past, and maybe it's the first thing that gets sold. But I do think that's going to change because if you look at the flows now, and I read an interesting stat about some of the top thematic ETFs out there. It's really NAVs that are bringing down the AUM for the ETF companies. It's not necessarily consumers redeeming. So I think at these low levels, actually, these low pricing levels, when you think about themes like 5G, electric vehicles, hydrogen, just sort of big tech secular growth, AI, things along that line, blockchain technologies. I do think that investors who have cash on the side to deploy, particularly young investors, are going to start looking at some of these ETFs, and they're going to position perhaps 5% of their allocations into some of the interesting themes that they like, and they'll hold it for longer periods of time. But yeah, I mean, in the long term, a lot of the top thematic ETFs are suffering because, they represent technology and disruption, and that also translates often to small cap growth and, pain when interest rate gets hiked.
Sylvia, it's always great to catch up. Really useful insight. Thank you very much indeed. Sylvia Jablonski, CIO and CEO of Defiance ETFs. Coming up, we're going to take you back to that data, that ISM data we saw at the top of the hour. Tough April for the US economy, certainly for the manufacturing sector. Tim Fiore, chair of the ISM Manufacturing Business Survey Committee, is going to join us next. He's going to work through the data. He's going to tell us which bits we really want to be paying attention to here. This is Bloomberg.
Find answers now.
So let's get back to that ISM number we got out at the top of the hour. The data from the Institute for Supply Management maybe showing the manufacturing activity in the United States turning a little bit lower, certainly adding to the growth jitters that the market is starting to focus on right now. Let's figure out what we should know here. Let's figure out exactly how we should read these numbers. As ever, to provide some insights, we're joined now by the chair of the ISM Manufacturing Business Survey Committee, Tim Fiore. Tim, great to catch up. How should I read the numbers? Give me the takeaway.
Well, complicated report. I think the situation here is we underperformed, we disappointed a bit, but I think a lot of it had to do with timing. The timing from the standpoint of manufacturing inventory has sagged more than I would have thought, and especially timing from the demand side. I think the demand side really was stronger, except for new export orders. Our backlog is still 85% of the comments are growing or the same level of backlog. So I think the real story, Guy, this month is around employment. And the fact that because we couldn't really hire enough people on the factory floor due to a lot of turnover, primarily because of quits, we weren't able to see that production number come up. And I do think that the month of May we'll see inventory come back. I think that you're going to see that new order number come back. I'm more concerned about employment and production.
Dig into us a little bit, into that employment number with us a little bit, if you don't mind, Tim. I think it's really key that you highlight this is about not being able to attract enough laborers as opposed to cutting jobs available on the market. Talk to us about the comments and some of the details that you're getting in your survey with respect to that.
So we have an overwhelming amount of people who are hiring versus trying to manage their headcount through attrition. No comments really around firing. And in the month of April, we actually saw 38% of the employment comments saying that they were having difficulty in hiring versus 31% back in March. So it kind of is going the wrong way. And if you dig into the detail, it's really around the turnover level, and that's really people quitting for other jobs.
Walk me through the prices paid number.
Well, we were coming down until the Russia-Ukraine conflict, and then we started to turn around, primarily driven by energy numbers. I mean, that's really what's happening, is that the price of a barrel of crude is worldwide very high. It's hurting our natural gas prices here in the U.S. as we export more gas into Europe. And crude oil gets into everything: plastic, steel, transportation. So most of our panelists saw an immediate impact on transportation, and people didn't wait this time to actually see it. They began to pass along immediately. That's what you learn when you finally, in 2021, when we finally passed along increases. We probably waited a little bit too long. The second time around, nobody's going to wait.
Just in terms of how manufacturers are sourcing product, though, are they getting better at it? As you say, this is something that caught a lot of people on the hop. Maybe they got the timing wrong when they passed prices on, if I can spit those words out. But are they getting better now? Are they getting more creative in terms of being more flexible in terms of what they put into the business and the prices they're paying for the stuff they're putting into the business as well?
So our investment sectors are really strong. Our capital equipment sectors, computer electronics, machinery, those numbers are really strong. I mean, that's obviously what you really want to look at, is what's happening in that area. And I think that the biggest issue here is really we have really long lead times. We have record capital equipment lead times, and raw material lead times have never been this long. And we're sitting here at the highest price point that we've probably seen in the last 35 years. That's causing buyers to pause and wait. I think they have orders laid out much longer than they normally do, and they're probably at much higher prices than they would really like to pay. So I think in some respects, that's why you saw the new order number come down a little bit, because they've got orders probably out all the way to 2023 at prices that they really don't want to pay. But I think the month kind of indicated that we're starting to see some kind of price easing. 4% of the comments were lower prices compared to 1% in March. I think that's positive. It'll move in the right direction. On the supplier delivery number, I think we're going to continue to move closer to a 62, 60 kind of level. And the big concern here is production and just getting enough people on the factory floor to really convert that product. Because as you saw in the first quarter, durable and non-durable goods are still very positive, as we've been indicating in the PMI number.
Any detail you can provide on that net export number? I mean, I think that most investors have a sort of gut check reaction when they see the net export number deteriorate. They think, ooh, dollar. It's all about this dollar strength. Is there any evidence in the comments that this is currency related, or is it just a slowdown and a lot of friction still in supply chain?
Well, I think in Q4 of last year, we had a lot of difficulty getting containers into the U.S. ports. We struggled with that all the way to the Lunar New Year in the February timeframe. In February and March, we kind of freed that up. So we had a lot more imports coming. I think it's more of an import story. And it's really timing between Q4 and Q1. So we had a really high GDP in Q4, but we weren't able to unlock that import number. So I think a bit of that caught up to us in Q1. But I'm really concerned, though, about the future here because you've seen the amount of liners piled up outside of Shanghai and Ningbo and the major ports in China. They've had the ports shut for about a month. There's difficulty in transporting product to the ports inside of China. And all that's going to lead to is a big tidal wave of container ships sailing to the U.S. And we're going to be back in the September-October timeframe of last year when you're going to have 100 ships waiting to be unloaded. That's going to put strain on the road freight situation in the U.S. You're going to see spot rates go back up. And then, on top of that, we have a labor union negotiation going on the West Coast in July. And then when that's over, you got the season rush. So, I think the only seasonality that we really had in COVID is the holiday season. Everything else has been dealing with long lead times.
Tim, just to kind of start to wrap this conversation up, the market's initial knee-jerk reaction was that this was a negative number. I've listened to you, and I'm hearing that this is an economy that is still humming along. It's got shortages. Those are the bottlenecks that are providing problems right now. How would you characterize, just in a few words, what these numbers should tell us about where we are with the U.S. economy?
I think we're still really strong. Your last guest really commented about no sign of recession, inside of next year sometime. We're 23 months into what typically is a 34 to 35 month manufacturing expansion cycle. And we think we've had a governor put on because of the supply constraints, which means this is probably a 40 to 42 month expansion cycle. So we're really not seeing any indication of weakening demand here at all today and not expecting anything really until the end of next year. I think it's a 2024 discussion, if that. So, we had 3-to-1 positive demand comments and not so positive. The number of comments is really hard to figure out these days because I have a lot more people talking about price increases and late deliveries in the general comments, but no indication at all that there's any easing of demand. Like I said, the backlog number, 85% are the same or better than it was in the prior month. Customer inventories are still well below 40. And you can explain the new export number because of what's going on in Europe and Asia. So I think we're in for a strong run. We're continuing to be in for a strong run.
Glass half full. Tim, it's always great to catch up and get your analysis on how we should read these numbers. Really appreciate your time as ever and the data that you deliver for us on what is happening out there. Timothy Fiore of the ISM Manufacturing Business Survey Committee, thank you very much indeed. This is Bloomberg. So we're coming up on the European close. Now remember, London is out today. That is a big chunk of volume that is taken out of the European space, but there's still plenty of interesting stories that we want to be talking about here. One of them represents this market here, Stockholm, the OMX, a little bit earlier on. I'm sitting there at my desk, suddenly the market nosedives. It's down by 8%. Turns out it was something of a flash crash. It spreads across the Nordic markets. We've come up off that low, but still down pretty hard. Euro dollar down by 0.2%. Brent crude down by 3%. We're going to talk about energy in the next hour. The European close is coming up. This is Bloomberg. Monday, May the 2nd. London's out for a holiday. The rest of Europe getting hit pretty hard. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So we had a flash crash in Stockholm a little bit earlier on, like volume probably a factor in there, but certainly a fat finger may be possible as well. It wasn't hacked and it wasn't a technical glitch. We'll talk about this in a little bit more detail later on, but that market was down by 8% at one point today. We've recovered from there. The main markets that are open today are down circa 1.5%. Partly a reaction to what's happening in China, partly a reaction to that big sell-off Friday that we saw in the United States. Euro dollar trading down by 0.2%, still got a 105 handle, fairly stable today relative to the volatility we've seen of late. Brent crude, though, is interesting, tracking back down towards 103. We're down by around 3% today. The debate in Europe is whether or not we're going to ban Russian oil. It's a tricky thing to do. We're going to get some more details in just a moment. Crudy, what are you seeing over there?
Yeah, well, a little bit different than the risk-off sentiment you're seeing in Europe, but simply a little bit pairing some of those gains. Remember, just 30 minutes ago, I was here pointing to over 1% gains in the NASDAQ. That has since been paired. You can really see that. The NASDAQ still outperforming the S&P 500, but the S&P 500 essentially flat. So whatever technical bounce that was driving the market earlier, it looks like it's dissipated just a little bit. And instead, you've seen a stronger dollar. So I wonder how much of this is coming back to that growth story, the growth story that you were actually referring to when it came to the oil space. You also see it very clearly in the copper space. Now, this is very clearly going to be a China story, but the question here is if you already see these commodity risk assets really ringing the alarm bells, how much longer can the S&P 500 and the NASDAQ really stay in the green? And Guy, it seems like that fade is already in the works.
Absolutely. Part of this is down to what is, of course, happening with the energy story here in Europe, the Ukrainian situation. Everybody's keeping a firm eye on what is happening here. European energy ministers are meeting in Brussels. They've been discussing throughout the day their response, of course, to Vladimir Putin's demand that Russia be paid in rubles for its gas. The German economy minister, Robert Habeck, told Bloomberg Television's Maria Tadeo about where Germany stands on the debate.
After 2 months of work, I can say Germany is not against an oil ban on Russia. Of course, it is a heavy load to bear, but we are ready to do that.
The intro was a little wrong. He's talking about oil, not gas.